On April 23, 2023, in the bustling financial district of New York City, a critical incident unfolded within the sprawling infrastructure of the global financial markets. The main actor in this narrative was a prominent investment firm, Apex Financial Technologies, which had rapidly implemented a sophisticated automated trading system designed to execute trades at unprecedented speeds. This algorithm, driven by high-frequency trading strategies, aimed to capitalize on market inefficiencies and maximize profit margins. As the trading day commenced, the automated system encountered a significant programming flaw in its code, specifically related to a miscalculation in the logic governing trade execution parameters. The flaw arose from a failure in the internal testing protocol, which did not adequately simulate real-world market stress conditions. This oversight allowed the algorithm to misinterpret market signals, triggering a sudden series of automatic sell orders across multiple asset classes when certain predefined thresholds were met. The initial technical failure manifested in the form of a deluge of sell orders concentrated on tech stocks. This unexpected execution of trades disrupted the normal market equilibrium, leading to a rapid decline in stock prices. Within minutes, Apex Financial System executed over 1.5 million sell orders, liquidating approximately $650 million worth of assets. The algorithm's erroneous actions caused a ripple effect, affecting not only Apex, but also other trading platforms and exchanges connected through real-time market feeds. Major tech stocks, such as Xylotech and Smart Grid Technologies, saw their prices plummet by as much as 30% within an hour of the algorithm's failure. As the day progressed, the measurable impacts of this incident became evident. Trading volumes skyrocketed, with a reported increase of over 200% in transactions compared to an average trading day. The volatility index surged, highlighting growing panic among investors. Margin calls began flooding into brokerage firms as the plummeting equities triggered cascading liquidations. The overall market lost approximately $1 trillion in value within just a few hours, as capital flight ensued amid fears of systemic instability. This sell-off led to disrupted service on several prominent trading platforms, causing further transactional chaos. Internally, the initial response from Apex Financial was one of confusion. Employees scrambled to assess the unfolding situation. Internal emails were exchanged frantically as team leads attempted to piece together the malfunctioning logic of the trading algorithm. The company's incident response team initiated a thread in their internal communications channel, seeking immediate answers, while also working on partial fixes. Assumptions were made that the issue would be contained and manageable. Some team members hypothesized it might simply require a shutdown of the affected algorithm. However, others raised concerns about the broader implications of the algorithm's interconnectivity with other systems and the associated vendor dependencies. Externally, early signals of trouble began to surface as users and investors took to social media platforms to express their grievances and confusion over the sudden market crash. Trading platforms like Trade Central and Bull Run experienced heavy traffic spikes due to frustrated users trying to access their accounts or halt trades. Monitoring alerts triggered within regulatory bodies, indicating unusual market activity, prompted concerns about volatility thresholds being breached. Minor media mentions began to emerge, highlighting the sell-off prompted by the algorithm's failure. But the full scope and implications of the situation remained unclear. As confusion reigned at Apex Financial, an internal working group convened to assess whether the programming flaw originated from recent updates, or if it was an underlying issue overlooked for an extended period. This ambiguity complicated their response strategy. Staff members debated implementing immediate emergency overrides to halt all automated trading activities, fearing that any further orders could exacerbate the already chaotic market environment. Yet, a faction asserted that doing so could lead to further investor panic and exacerbate losses, suggesting instead fine-tuning the algorithm to contain the damage. Amid the internal turmoil, external stakeholders increased their vigilance. Regulatory agencies began discussions about whether increased oversight over automated trading systems was necessary. As Apex Financial's situation worsened, whispers of instability at the firm spread through financial news networks. While the immediate effects on Apex were severe, experts in the financial community began to question the resilience of the entire automated trading ecosystem. Questions arose about the vulnerability of interconnected trading systems and whether other firms were similarly exposed to systemic risks. The scale of the sell-off catalyzed investors to reassess their risk exposure across their portfolios. Institutions with significant stakes in tech stocks began to signal their intent to liquidate assets, fearing that exposure to volatile trading algorithms could lead to even greater losses in the coming days. The feedback loop of fear and loss continued to widen the gap between hope and reality, leading to a self-reinforcing cycle of panic. As Apex Financial grappled with the emerging situation, the screen of its trading floor lit up with further alarming alerts. An increasingly stylized wave of algorithmic anomalies began to appear across different sectors. Other investment firms reported abnormal market conditions, with various trading systems failing to operate correctly, echoing Apex's initial crisis. This disjointed alignment suggested that the flaws were more than isolated events. They were symptomatic of a fractured system plagued by misconfigurations, automation dependency errors, and insufficient oversight. By this point, the repercussions of Apex's automated trading failure had expanded beyond its initial confines. As the market teetered on the brink of a more profound crisis, additional investigations were initiated into the large firms utilizing similar high-frequency trading systems. An ominous confluence of factors created a scenario ripe for further escalation. Just as regulatory authorities began establishing a critical eye on the automation practices within the financial markets, the first global investor conference was scheduled in response to the turmoil, promising to address sweeping changes to practices and regulations governing automated trading. With momentum building both internally within Apex and externally across the financial community, the unfolding narrative hinted at a deepening crisis. What began as a single flaw in a trading algorithm now threatened to challenge the very foundation of automated trading, highlighting weaknesses within an industry that had previously prided itself on the precision and efficiency of its technological advancements. The ramifications of this incident were far from over, and the situation was poised for further complications as interconnected systems began to react unpredictably to the turmoil. As the Global Investor Conference unfolded, key players from major financial institutions gathered to address the concerns raised by the events originating from Apex Financial. Legal representatives began circulating drafts of proposed regulatory changes, emphasizing the need for stringent monitoring of high-frequency trading algorithms to prevent similar incidents. However, as discussions progressed, it became clear that trust among investors had significantly eroded. The unfolding situation prompted further sell-offs across multiple exchanges, amplifying the scale of the crisis. In a bid to contain the growing panic, several financial authorities issued preliminary advisories indicating they were scrutinizing algorithmic trading practices. Apex Financial's stock price plummeted as investors reacted to news of potential regulatory interventions and ongoing investigations. Many companies in the sector faced mounting scrutiny, compelling them to preemptively suspend some automated trading operations. The ripple effects reached global markets, leading to trading outages at several major exchanges, which further delayed responses to emerging issues. As the crisis continued to exacerbate, an internal audit at Apex Financial revealed that the initial programming flaw had been compounded by insufficient testing protocols and unheeded warnings from engineers regarding potential vulnerabilities. These findings, once leaked to the press, quickly became the focal point of media coverage, fueling public outrage and distrust regarding the reliability of automated trading systems. Subsequently, government agencies initiated a comprehensive audit of major financial firms employing automated trading. Subpoenas were issued to Apex Financial and multiple competitors, seeking documentation of their algorithmic trading strategies and compliance with regulatory standards. Mismanagement from Apex Financial resulted in legal actions from shareholders who accused the company of misleading information and negligence, culminating in substantial financial settlements. Over the following months, Apex Financial declared bankruptcy as ongoing legal battles drained resources and investor confidence dwindled. The fallout from this incident reverberated throughout the industry, leading to the resignation of several key executives across various firms designed around high-frequency trading. Many companies implemented emergency changes in their operations, prioritizing transparency and regulatory compliance by overhauling algorithm testing protocols and increasing human oversight in trading activities. By late 2024, amid the chaos that followed, numerous institutions began shuttering their automated trading divisions entirely or significantly downsizing them. The entire landscape of the financial market was forever altered as investors demanded a new paradigm where technology and risk management were balanced more judiciously. As a result of the cumulative measures taken, the regulatory bodies completed emergency revisions of policies governing algorithmic trading compliance, introducing stricter oversight aimed at safeguarding against systemic failures. Although the immediate concerns regarding algorithmic trading subsided, the impacts of the crisis were long-lasting, fundamentally reshaping the operational approaches within the financial sector. By January 2025, market analysts noted a complete metamorphosis within financial institutions, indicating a recovery trajectory based on enhanced oversight and renewed trust in human decision-making processes. However, the ramifications of the Apex Financial scandal served as a stark reminder of the potential dangers inherent in automated trading systems. The final status of Apex Financial was archived as dissolved, with key findings illustrating failures in governance and risk management within the automated trading space.